Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Focus Universal.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's just get right into it because we have a really fascinating setup to talk about today. I want you to imagine looking at this tiny, like 10-person company.
Right.
Their revenue is shrinking. They are burning through millions of dollars a year. And their core hardware business just seems completely dormant.
Yeah, totally flat.
Exactly. On paper, this is, the exact type of microcap stock you would normally just run as far away from as possible. But last week, this exact same stock triggered a violent 146% market circuit breaker to the upside.
Oh, yeah. It was wild.
The exchange literally had to halt trading because the buying frenzy was just so intense. So today we are figuring out why. We need to dissect the mechanics behind this explosive move, understand the massive strategic pivot this company is attempting, and really weigh the very real threat of your shares getting diluted against what honestly could be a massive asymmetric upside.
Yeah, and to really understand that foundation, like that 146% explosion, it all comes down to a complete identity shift for the company.
Okay, an identity shift.
Yeah.
What do you mean by that?
Well, for years, Focus Universal has been categorized basically as a hardware manufacturer. We are talking about the Internet of Things, 5G hardware components, that kind of stuff.
Right, physical tech.
Exactly. And the problem with being a microcap hardware company is just the sheer capital intensity of it all. You are constantly battling global supply chain bottlenecks.
Oh, yeah, the shipping logistics alone.
Right. You've got fluctuating raw material costs, physical warehousing, shipping logistics. It is just a grueling, low-margin business environment to be trapped in.
Yeah, especially for a company of that size.
Definitely. So what the market is reacting to right now, the reason for this frenzy, is Focus Universal aggressively pivoting away from physical hardware to become a pure-play AI automation software company.
Okay, but, look, the market certainly loves a good AI narrative right now. But just throwing the letters A and I into a press release, that doesn't usually cause a stock to halt on a circuit breaker.
No, it doesn't. Usually you just get a little bump and then it fades.
Right. But the real catalyst here hit on April 1st, 2026, when they announced what they are calling a task execution AI. And I think this is where we really need to dig in, because when most of us hear artificial intelligence today, our minds immediately go to generative platforms.
Yeah, like the big consumer-facing ones.
Exactly. We think of ChatGPT writing marketing copy or, Mid-Journey generating digital art.
Yeah.
Generative AI is inherently built to be creative. It takes vast amounts of data and predicts the next most likely word or pixel to create something entirely new. But the product Focus Universal is engineering, is strictly deterministic.
Yeah, and that distinction, the difference between generative and deterministic, that is basically the entire investment thesis here.
How so? Like if you were to explain that to someone just looking at this space for the first time.
Well, think about it like this. If generative AI is this, brilliantly creative novelist who occasionally just makes up facts to keep a story entertaining.
Which the tech industry so politely calls a hallucination.
Exactly, a hallucination. So if generative is that creative novelist, then deterministic AI is a strict, hyper-focused, humorless accountant.
I love that analogy.
Right, it doesn't create. It executes. Its math must be completely flawless every single time. And Focus Universal is applying this deterministic model directly to Securities and Exchange Commission financial reporting.
Wow. Okay, just think about the stakes of that specific niche for a second.
Yeah.
If you are a chief financial officer at a publicly traded company, a creative novelist is literally the last thing you want anywhere near your balance sheet.
Oh, absolutely. It would be a nightmare.
Right, because if your software hallucinates a revenue figure in a quarterly 10Q filing, you don't just get a typo. You face a devastating audit, millions of dollars in fines, massive shareholder lawsuits, and executives potentially facing federal prison time.
Yeah, the accuracy there isn't just some nice luxury feature to have. It is a strict legal requirement.
So is that focus targeting that hyper-specific SEC reporting niche? Is that actually a stronger, more defensible moat than trying to build a do-it-all AI?
Oh, 100%. That's why targeting the SEC reporting process creates such a formidable competitive moat for them. Because look, building a massive do-it-all consumer AI requires competing directly with trillion-dollar tech giants.
Right, the big players.
Exactly. But providing a highly specialized, low hallucination tool that automates audit-ready financial documents. That is a classic picks and shovels enterprise strategy.
Because everyone needs it.
Every single public company is legally mandated to file these financials. It is a non-discretionary expense.
Right, you can't just opt out.
No. When a corporate finance team looks at their budget for the year, compliance software is never on the chopping block. Focus Universal is attempting to sell a direct painkiller for literally one of the most stressful, high-liability tasks in corporate America.
I mean, the narrative of replacing manual, error-prone financial auditing with deterministic AI, it sounds phenomenal on paper.
It does.
But building enterprise-grade, flawlessly accurate AI software requires serious computing power and, high-level engineering talent, which does not come cheap.
No, it really doesn't.
So when we actually look under the hood at the trailing 12-month financials, the reality of funding this pivot looks a bit grim. Focus Universal is currently reporting roughly $255,000 in revenue.
Yeah.
Which not only is that a tiny figure for a publicly traded company, but it represents a 17% year-over-year decline. The top line is actively shrinking.
Yeah, and honestly, the bottom line is even more severe. They are carrying a net loss of negative $4.79 million over that same 12-month period. And that's accompanied by a gross margin of negative 13.8%.
Wait, negative 13% gross margin?
Yeah. Meaning it currently costs them more money to produce and deliver their goods than they actually make from selling them.
Ouch.
But when analyzing a microcap turnaround like this, you really have to contextualize these numbers, that negative margin. Yeah. That is the ghost of their legacy hardware business.
Right, because hardware is so brutal.
Exactly. Manufacturing physical IoT devices involves purchasing silicon, plastic, paying for factory time. But a software model completely changes those unit economics.
Because once an engineering team perfects the code for this SEC-compliant AI, the cost to duplicate that software and license it to the next CFO is practically zero.
Right. You completely bypass the factories, the shipping containers, the physical inventory.
So a successful pivot means those negative 13% margins could, theoretically, inflect into the, 70 to 90% gross margin range.
Yeah, exactly the range we typically see with high-performing software-as-a-service businesses.
Okay, but surviving long enough to reach those sauce margins requires cash.
It does. It requires a pristine balance sheet, which is, surprisingly, the absolute strongest fundamental pillar Focus Universal has right now.
Really? With those losses?
Yeah. Because despite the heavy losses, they maintain a debt-to-equity ratio of just 0.14.
Oh, wow. That is incredibly low.
Right. They have a leverage-light capital structure, meaning they aren't suffocating under toxic debt covenants or these massive interest payments that usually crush microcaps. Simply, WallSaint even assigns them a financial health score of 6 out of 6.
6 out of 6.
Yep. The immediate risk of insolvency is actually low because the balance sheet is just so exceptionally clean.
Okay, I hear you. A clean balance sheet is great.
Yeah.
And let me play devil's advocate here for a second.
Yeah.
We still have an operating cash flow of negative $5 million. And the company only employs about 10 people. How on earth are 10 employees burning through $5 million while generating $250,000 in revenue? I mean, this looks suspiciously like an early-stage, cash-burning venture capital startup that somehow just ended up trapped inside a publicly traded ticker.
Yeah.
How long can they survive that burn rate without diluting investors?
That is the million-dollar question, right? Or the $5 million question. But you have to remember, operating as a microcap public company carries an incredibly high baseline cost before you even pay a single engineer's salary.
Just to exist on the exchange.
Exactly. You have exorbitant directors and officers liability insurance. You have mandatory independent audit fees, legal counsel, exchange listing fees.
All of which add up fast.
Super fast. When you combine the baseline cost of simply being public with the intense R&D required to build a deterministic AI from scratch, a $5 million burn rate for a 10-person team is just the harsh reality of the situation.
So the clean balance sheet basically buys them time, but it doesn't generate cash.
Exactly. Without a sudden influx of revenue or fresh capital, that ticking clock gets very, very loud.
Right. And with a ticking clock and millions in cash burn, standard market logic dictates the stock should be bleeding out as investors lose patience, right?
You would think so.
But instead, we saw an absolute technical explosion. On April 6, 2026, the stock surged 146.41% in a single trading session.
Yeah, the volume was insane.
The buy orders flooded in so aggressively that the exchange was forced to trigger a circuit breaker halt to the upside.
Right. And for anyone unfamiliar with the actual mechanics of a circuit breaker, an exchange will physically stop trading on a stock when the order book becomes dangerously imbalanced.
Like too many buyers and no sellers.
Exactly. There were so many aggressive buy orders and so few sellers willing to part with their shares at those current prices that the system just pauses to allow the market to digest the price discovery.
It's like the system needs to catch its breath.
Yeah, it is the ultimate technical signal of aggressive, undeniable accumulation.
But contextualizing that surge really requires looking at the historical chart, doesn't it? Because the 52-week range on Focus Universal is staggeringly wide.
Oh, it's massive.
The stock recently hit a low of $2.74, but the 52-week high is all the way up at $61.40.
Yeah, that is a huge drop.
A fall from over $60 down to under $3 means the stock has been heavily structurally oversold for a long time. The sellers simply exhausted themselves.
Right.
And once the selling pressure dried up at that bottom, any spark of positive news was going to create a volatile reaction.
And we actually saw early indications of that spark forming ahead of the April 6 explosion.
We did.
Yeah, if you look back at March 27, the daily trading volume spiked to 15.7 thousand shares.
Which is high for them.
For a dormant microcap, that is a massive anomaly. Speculative accumulation was happening before the official AI announcements were even released to the public.
Ah, so somebody knew something.
Well, institutional whisper networks often position themselves ahead of these major strategic pivots. What we witnessed after the halt was a forceful market re-rating.
Okay, walk me through that re-rating.
So the market realized it was pricing Focus Universal as a failed hardware manufacturer, right? And aggressively started repricing it as an active AI software developer.
Oh, and that kind of sudden regime change completely traps short sellers.
Oh, absolutely traps them. Anyone betting against the stock based on the old hardware metrics suddenly finds themselves deeply, deeply underwater.
Right, because the price is skyrocketing.
And they are forced to buy shares on the open market to cover their short positions, which creates a massive feedback loop of buying pressure.
Right alongside all the new momentum capital coming in.
Exactly. The sentiment data surrounding the resumption of trading confirmed this momentum. The demand just continued to overwhelm the available supply.
And a triple-digit percentage gain like that immediately triggers algorithmic conclusion on the, top movers and most active lists across all the major retail brokerage platforms.
Oh, for sure.
Which is where the psychological FOMO, the fear of missing out, really takes over the retail market. Traders log into their brokerage accounts. They see a ticker up over 100%. And they blindly buy in, just to catch a piece of the momentum.
Yeah, they see green and they click buy.
Furthermore, explosive, halted breakouts like this in the microcap space frequently precede unannounced material events. There is heavy speculation that this SEC software might be securing pilot programs or early enterprise contracts.
Though we should note, nothing is officially confirmed on that front yet.
Right, we have to be clear that nothing is confirmed, but the price action heavily suggests the market is pricing in a high probability of actual deployment, not just theoretical software.
Yeah, but pricing in future deployment is basically the entire function of the stock market. But betting on the future of a sub-$4 million microcap introduces some severe structural risks.
Risks that can wipe you out if you aren't careful.
Exactly. You can very easily become the victim of the exact same market mechanics that are driving the price up right now.
Let's talk about the bear case then. A 136% single-day pop is thrilling, but as wealth builders, avoiding traps is just as important as finding runners. What are the severe risks lurking beneath the surface here?
Well, the primary trap lurking beneath this rally brings us right back to that negative $5 million cash burn we talked about.
Ah, because a tiny company burning cash has to fund its operations eventually.
Right, and their primary mechanism for survival is the secondary market. They essentially use their publicly traded stock as an ATM.
Okay, explain how that works for our listeners.
Sure. So management will authorize the creation of millions of new shares and sell them directly onto the open market to raise the cash they desperately need to keep the lights on.
And that process of issuing new shares dilutes the ownership percentage of every single existing investor.
Precisely. If you own 10% of a company and they double the total number of shares in existence to raise cash, your ownership is instantly cut in half. The value of your investment is crushed even if the underlying business hasn't changed one bit. And this risk is highly imminent for Focus Universal.
I mean, management is looking at a stock that just surged 146%. They know they need cash.
Exactly. This price spike presents the absolute perfect opportunity for them to execute a secondary offering at a massive premium.
So wait, that retail visibility and FOMO we discussed earlier being on the top movers list, that suddenly looks incredibly dangerous.
It's a double-edged sword.
Are the retail traders rushing in to buy the breakout actually just providing the necessary exit liquidity for the company to dump new shares?
It is a very real possibility. If they announce a massive stock offering tomorrow to fund their AI development, the market gets flooded with new supply, and the upside of this current rally is instantly capped. It is the classic micro-cap volatility trap.
And risk number two is just the inherent volatility of a tiny float, right?
Oh, yeah. The float, which is the actual number of shares available for public trading, is so small that it takes very little capital to manipulate the price.
Right.
A coordinated block of buy orders can send the stock into orbit and trigger circuit breakers, but a block of sell orders or a dilutive secondary offering can crater it just as violently.
So if the upcoming announcements lack concrete evidence of enterprise revenue or signed contracts, this massive surge could easily reverse, sending the stock crashing right back down toward that $2 low.
Exactly. The floor can fall out incredibly fast.
So weighing the existential threat of dilution against the structural brilliance of a deterministic, SEC-compliant AI moat, it leaves us with a very specific strategic setup.
It does. And navigating this requires a strict focus on the catalyst calendar.
What's the next big date?
The most critical date approaching is earnings on May 6, 2026. This report will basically force management to provide transparency.
The market will be aggressively scrutinizing the commentary for any tangible proof of AI revenue traction, right?
Right. Or, at minimum, the formal announcement of beta testing partnerships with corporate finance departments. They need to show real-world progress.
Now, evaluating this setup also requires looking at the broader macroeconomic environment. We are currently seeing broad weakness across the tech sector, mostly driven by geopolitical tensions in the Middle East and just general market anxiety.
Yeah, it's been a tough macro environment lately.
Usually, speculative microcaps are the very first assets to be liquidated during a macro sell-off. But Focus Universal's specific enterprise niche kind of acts as an intrinsic hedge against that macro volatility, doesn't it?
It absolutely does, because corporate compliance isn't optional.
Exactly.
A geopolitical conflict or a supply chain disruption doesn't change the SEC filing deadline. A CFO cannot skip their quarterly audit just because the broader indices are trending downward.
Right. The demand for flawless financial reporting is legally insulated from standard economic shocks.
Yes. So when you combine the structural analysis of this turnaround narrative with the technical setup, it gives Focus Universal a bullish score of 7 out of 10.
7 out of 10.
Yeah. The asymmetric upside of successfully disrupting corporate auditing is just massive. However, the severe execution risk and that looming threat of shareholder dilution dictate exactly how this must be traded.
It's not a set-it-and-forget-it stock.
Definitely not. It is a high-reward swing trade that could eventually transition into a speculative long-term portfolio hold, but only provided the company proves its software can actually generate sustained enterprise revenue.
And chasing a stock immediately after a circuit breaker halt is generally just a recipe for disaster anyway.
Oh, always.
The ideal strategy is waiting for the extreme volatility and retail FOMO to cool off. You look for the chart to establish a new, higher floor of support on lighter volume, providing a much safer technical entry point ahead of that crucial May earnings catalyst.
Yeah, patience is absolutely key here. Let the chart settle before making a move.
Exactly. Well, as we wrap up today's analysis, I want you to consider a broader, maybe more philosophical shift happening in the market right now.
Yeah.
We just watched a tiny cash-burning microcap trigger a violent buying frenzy simply by promising to build an AI that does SEC paperwork.
Yeah, paperwork. It doesn't get much drier than that.
Right. For the last few years, Wall Street has been completely obsessed with flashy, generative AI. You know, the consumer-facing software that writes poems and paints beautiful pictures.
The cool stuff.
The cool stuff, yeah. But perhaps we're entering a new era of capitalization. Is the real sustainable wealth going to be built by hyper-specialized, incredibly boring, deterministic AI?
It's a great question.
Because the kind of invisible software that simply does the math perfectly and keeps executives out of federal prison, that might just be the most valuable technology the market can price today. It's definitely something to keep in mind as you build your own portfolio.